Saturday, March 7th, 2020, Monaco 64, home of alternative economics and contrarian views. So the stock market recovered a little bit last week. They eked out small gains, both the Dow and the S&P. They rallied quite well towards the end of the day yesterday. They probably would have been down on the week if we hadn't seen the rally in the last hour or so in the stock market. But the bond markets are giving mixed signals. We've got the government bond market, of course, rising like a rocket, yields dropping dramatically. I've never seen such big drops as we saw yesterday overnight from Thursday. Huge drop in treasury yields. We'll look at that in a minute. But I also want to cover the corporate bond market. The corporate bond market is not doing as well as the government bond market, and it's starting to show signs of cracking. I'm going to reference a couple of articles, and I want to look at corporate bonds that could potentially become fallen angels, and I'll explain what that is when I go through these articles. So for the week, the Dow was up 1.79%. Of course, we're down about 10% the week before, the week starting 24th of Feb. That was kind of a black week, I would say. S&P was up 0.61% on the week, and the NASDAQ basically unchanged. It was only up 0.1%. Let's have a look at gold and silver, of course. Gold yesterday, quite a wild ride. We got up to a new high yesterday at just above 1690, around 1692. And then it just turned around, went back down to 1641, and then rallied back almost up to 1682, I think, before the close. But we finished at 1673.75 on the week. That's the spot price of gold. So it was up almost $100 on the week. Because if you remember well, the previous week we had closed at 1585. We'd had a huge drop on that Friday. So yeah, it was a bit of a wild day yesterday in gold, but it actually did very well last week. I think it was the best week in many years for gold. So it's still looking pretty good. The dollar index is not looking good, as you can see here by this chart. So I think, as I've said before, it's gold's turn in US dollars to make new highs. All the other major currencies have made new highs already this week. I think silver is about to take off. We just need to be patient. And when it does, it's going to outperform gold. So let's have a look at the bond markets. As many of you know, I worked in the bond markets, in the government bond markets for over 20 years. So I know what I'm talking about here. Of course, in the bond market, when prices rise, yields drop. And that's what the yields basically set interest rates in the markets. So the higher bond prices are going, the lower yields are going. And I've said a few times in the last few weeks that yields were dropping, and they were indicating to me that the Fed would have to cut and that they might even need to cut prior to their meeting on the 19th and 20th of March. And lo and behold, they had an emergency cut this week of 50 basis points. I was, to be honest, not surprised by that cut, as I've been talking about the fact that they might have to, because the market was signaling to them that they needed to cut. So let's start with the 30-year bond yield. And that's the longest maturity for Uncle Sam or for U.S. Treasuries. And I'm going to start looking here on the 24th of February, because that was the beginning of the week before last when stock markets started crashing. And you can see that the 30-year yield was just below 2%. And then it just kept dropping And what that means is that investors were rushing from riskier assets into government treasury market. Some of you, of course, might think, why would they rush to paper? We know paper is going to become worthless, but a lot of people still view treasuries as a safe asset. And one of the reasons for that is that, as Alan Greenspan once said, the US government can always print more and more credit or create more and more credit to pay off older credit, so they won't go bust. Of course, the purchasing power of that currency, which is backed by the debt, will keep going down. So that's why there's this rush. People are concerned about the economy, especially with the health crisis. So we've seen a big drop in yields, and it actually stabilized towards the middle of last week, as you can see here, around 160, 170. Still dropped quite a bit from 190 to 170. And these were record low yields already. And then from Thursday until yesterday, they had a huge drop, especially yesterday. As you can see here, we dropped all the way from 160 the previous day, kind of around 160, all the way down to 119. And believe me, that's a huge move in the 30-year yield. That's a huge move up in the bond markets. And that does not bode well for the economy. I know the stock market rallied last week, but I don't think it's out of the woods. Let's quickly look at the 10-year yield. This is more of a benchmark. People look more at this one. Prior to the 24th, the yield was around 1.5%. And at that juncture, 1.32% had been the record low yield for the 10-year. And that was touched in July of 2016. And I think it was close to that back after World War II in 1946. So on the 25th of February, we finally touched a new low in the 10-year yield, below 132, as you can see there. And then it kept going lower. We stabilized a little bit like the 30-year did earlier this week. But then again, Thursday and Friday, the yield just imploded. We had gone below 1%, of course. I was doing my video yesterday. I looked at the 10-year yield to report where it was, and I was shocked because it dropped from around 91 basis points, which was already really low, and we were around 70 basis points. So like a 20 basis points drop overnight. So as you can see here, the low yesterday was 66. So we had a 24, 25 basis points drop from the previous day. And that's huge, considering that the yield was even below 1%. So it lost a quarter of its value in terms of yield. So in my view, this is telling us that all is not well with the system. Yes, Wall Street is expecting the Federal Reserve or maybe even the Treasury to put stimulus into the system. I guess the government, that would be in the form of more spending, maybe tax cuts, higher deficits. The Fed, of course, would be maybe another, not maybe, I think they will cut again on the 19th and 20th. The date they will probably cut will be the 20th of March. They'll probably do another 50 basis points, I would say. But there's a lot of people out there now who think they could also do QE, and that they would do QE for the corporate bond market. The Federal Reserve, they only buy treasuries and agencies, mortgage-backed securities, which are kind of have a government guarantee. So that's the only kind of assets they buy right now. But I think, yeah, there's a lot of hope out there that they will start buying corporate bonds, just like the ECB and the BOJ have been doing, and I think also the Bank of England. So I found a couple of articles yesterday One on the Wall Street Journal. It came out, I think, yesterday afternoon. And it says, corporate debt engulfed by market turbulence. Investors sell junk bonds and bank stocks in Europe on fears of a deeper slowdown. As I said earlier, the corporate bond market is not government guaranteed. So with the prospect of a recession coming onto the world economy, we've already had in the UK one of the low-cost airlines collapse. So they went bust last week. Let's see what Paul Davies of the Wall Street Journal has to say. The market rout in stocks spilled into the corporate debt markets Friday after investors began to more fully assess the harm that prolonged economic disruption from the C disease could do to highly indebted companies. And I'll stop here for a minute. We know that the vast majority of the rise in stock prices in the last few years has been because of corporate buybacks. Cheap credit, low interest rates have allowed corporations of any ilk, be them high grades issuers or issuers that are near junk status, to borrow very cheaply and to buy back their stocks to make their earnings look better and to see the stock prices go higher so that their CEOs, directors can benefit from it, and shareholders. So now we've got the problem when a possible economic recession could cut into their earnings, could cut into their revenues, and they might not be able to pay back or service all this debt, right? So reaction to the virus had been relatively muted in credit markets. And by credit markets, they mean the corporate bond markets, not the government bond market, where yields on even riskier junk bonds and loans had remained below levels seen during the sell-off in late 2018. However, data on Thursday showed accelerating withdrawals from U.S. high-yield bond and loan funds in the past week, which was followed by a drop in European bank stocks, driven by investors' concerns over loan losses. In Europe, the cost of protection on risky corporate credit jumped to its highest level in nearly 4 years on the leading IHS market index of riskier credit derivatives, the iTraxx crossover. The cost rose to more than 388,000 euros annually to cover 10 million euros of bonds. This followed a sharp rise in the US CDX high yield index, showing that it cost more than 409,000 annually to protect 10 million of bonds at the close on Thursday. So these are the CDSs, credit default swaps. So the higher the cost to protect 10 million worth of bonds, the more it means that investors are concerned about the credit health of these issuers. While selling was broad-based, bonds of companies in sectors that could be most affected by the spread of the C disease, such as travel and energy, fell especially sharply. A 5.25% Caesars Resort Collection LLC bond due in 2025 dropped to 92.75 cents on the dollar from 96 7/8 cents Thursday, according to Market Access. A Laredo Petroleum Inc. 9.5% bond due in 2025, which was issued at par, fell 11 cents to 58 cents. So these are huge moves in the bond markets. Friday's selling was notable because credit markets are critical to the functioning of the economy. This is where it's so important. Earlier this week, companies of varying credit quality were still issuing bonds, and the average yield of U.S. speculative grade bonds remained below levels from last summer. according to Bloomberg Barclays data. But extended volatility could make it difficult for companies to borrow, exacerbating any economic hits from the C disease. So this is from a guy at Bank of America. He says, today was the day when it flipped from equity market leadership of the sell-off to credit market leadership, said Barnaby Martin, head of European credit strategy at Bank of America Merrill Lynch. We were building up vulnerabilities. This is what happens when the market reaches for yield, which is hubris. The rush to buy protection and withdrawal from bonds was driven by dedicated credit funds being forced to cut back positions, amplified by a lack of liquidity in the markets, according to one senior credit trader in London. This follows a wave of withdrawals from U.S. funds that invest in riskier credit, according to LCD, the loan research arm of S&P Global Markets Intelligence. More than $5 billion was pulled from U.S. high-yield bond mutual funds and exchange-traded funds in the week to March 4th, up from $4.2 billion the week before, according to Refinitiv Lipper. Corporate bond markets, or the credit markets, are very, very important to the running of the economy. It's where a lot of the credit is raised by these corporations, and that flows into the consumer, into the real economy. And as the guy from Bank of America said, basically on Thursday and yesterday, it flipped. People started to realize, wow, we could have a problem here with these corporate bonds. And with that, I want to actually look at the bonds that could become fallen angels. And bear with me. I saw this article actually on the 22nd of February. And this is another big problem, I think, for the credit market or the corporate bond market. And we could see this going forward from next week, becoming worse and worse as the crisis intensifies. And again, I'm not blaming the C disease for this. I think it's just the trigger for a big correction, big collapse of all the debt that's been created since the '08 crisis, a big bubble of cheap money and credit. And I'm not surprised this is happening. And I think this is the black swan, and it doesn't matter what you think about it, how it started, who started it. If it doesn't matter, be as it may, I think it is the black swan, and this is what's gonna make things a lot worse for the markets. I still think there's a lot of people out there that are very complacent. They expect the central banks to come to the rescue and everything to be okay, and they probably will come to the rescue, but I'm not sure it will make a difference. So let's look at the fallen angels. As I said, it's from February 22nd. It was out in the FT, and it says more fallen angels could cause big ripples in bond market. Downgrades for Macy's and Heinz have prompted parallels to GM and Ford in the 2000s. Aside from corporate bonds that are probably even better than, triple B, flipping earlier this week, we've got this problem of these bonds that could potentially become fallen angels. And they've gone from being around 700 billion in 2005 to being almost 3.5 trillion today. So in my opinion, that's a huge problem. Just want to show you before I finish off how big the bond market is. And this is data from SIFMA, which tracks the capital markets. So this is a capital markets fact sheet. You can see here the size of the equity markets, that's the stock market, worldwide in 2018 totaled $74.7 trillion, while the bond markets totaled $102.8 trillion. So the bond market is much bigger than the equity market. So Yes, we had a pretty good week for the stock market, considering what happened the previous week. The main averages, the Dow and the S&P, eked out small gains percentage-wise. But to me, the rush into government bond markets reflected in the collapsing yields, especially yesterday, and the problems evolving now and coming to the fore in the corporate bond markets makes me believe that we're not out of the woods yet. This crisis is very uncertain in terms of what can happen, in terms of what's going to happen to the economies of the world. We all know now about the global supply chain, all the change in sentiment for consumers. So I think, yeah, the stock market is still due for some big drops, in my opinion. We could still consolidate a little bit here, but be on the lookout. And I think volatility, of course, is going to stay very elevated because of the troubles in the bond markets. If corporations are not able to issue more debt, and a lot of times they issue this debt or the bonds in order to pay old debt. If they're not able to do that, if the bond market comes under more pressure, and by that I mean the corporate bond market, not the government bond market, we could see some big bankruptcies actually, and that could rattle sentiment even more. And as I said before, I don't think central bankers are going to be that effective this time, and I'm sure they're going to throw a lot of money or fiat credit at it though. If you enjoyed this video, make sure you hit the like button. Think about subscribing to the channel if you haven't yet. Please share it far and wide. And you can also follow me on Twitter, Facebook, BitChute, Steemit, and DTube. I wish you all a great rest of the weekend. Take care. Bye.